Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jarod Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. I'm your host today, Jarod Alexander, and I'm super excited to have our guest here, Gurjote Sethi. Welcome to the show.
Thanks, Jarod. Excited to be here.
All right. Well, I'm glad to have you here. And, Gurjote is a first-generation American based in the greater New York City market. Prior to starting Hukam Capital Group, he had a successful career spanning various industries, including real estate advisory, M&A, tech, and operation leadership. This diverse experience set provides him with a deep understanding of different sectors and the ability to comprehensively manage and expand the Hukam Capital Group portfolio. And also, one thing that I'm not reading out of his bio is we were just talking earlier about carless neighborhood, and I totally said that wrong, but essentially a neighborhood without cars. And I would love to touch on that as well, because Gurjote was part of working with a company building that as well, a new development deal. So, but with that said, Gurjote, if you could, walk us through your background, how you got into real estate, what made you want to get into the multifamily student housing space. We know you dabble in that as well. And yeah, just tell listeners, how you got to where you're at today.
Yeah, happy to. So, I grew up as a first generation American, as you kind of mentioned. My family immigrated from Kuwait back in the 80s. Back in Kuwait, they did very, very well for themselves. And then they immigrated here, effectively came penniless, started a couple different businesses, tried to find their footing, finally found their footing, and have a great retail business in Manhattan. As I grew up, I watched my dad work about 7 days a week, full 12 to 14-hour days for 7 days a week for 35 years. I've watched him do that. Incredible work ethic, really, really impressive that he's done all that. And one of the things that we talk about really often is why he never bought his building that his storefront is leased in. So he's been leasing his storefront for 35 years. Jarod, I'd love for you. So it's 1,500 square feet. So 1,500 square feet in Manhattan. I'd love for you to venture a guess how much he pays per month for that.
Ooh, let's see. Let me go $3,000 a month.
All right. $26,000 a month.
Wow.
Yeah. So that's Manhattan rents, right?
Yeah.
The $3,000 a month was accurate for 1985 when he started. Since then, it's gone up all the way up to 26,000. And for those of us who know how commercial real estate is valued, right? It's based off of your operating income. So if in the last 35 years his rent has, whatever that is, however much multiple that is, right? There's been a lot of equity that's created in that building. And so I've done the math. My dad has bought his building over about 4.2 times in those 35 years. And to me, that's the biggest missed opportunity in our family history is not buying that building. If we had, we'd have well over $10 million in equity in that building today. So watching that happen, and then growing up in this space where we did really well for ourselves. We own our house, so we're very fortunate for all of that. Seeing countless immigrant families, first generation families, and beyond that, just any family in general that has not had access to the ability to buy commercial real estate. But knowing that that has been one of the most critical cornerstones to the American wealth generation mechanism, and most people not being able to engage with it, we basically said we really want to create a fractionalized mechanism to allow individual families to engage with that themselves. And so that's when we started Hook'em Capital Group. You know, after a career in tech, I spent some time at Spotify, I spent some time at the Walt Disney Company. I did mergers and acquisitions consulting for several years. The real estate angle of the Walt Disney Company is very interesting as well.
Yeah.
It's twice the size of Manhattan, but 1/50th the density. So it's a very interesting place to do work. And then finally, reporting directly into the CEO at a company that was building car-free neighborhoods across the United States. And so while I was there, we acquired several development sites as well as built our first development in Arizona, right where you live, in Tempe, Arizona, where we launched our first 786 apartments and 30,000 square feet of retail. So really great experience there, kind of sitting in an institutional capital stack, learning what it's like to develop, learning the operations of an institutional master plan development like that. But then also the most important part of that was really understanding how tenants want to live. And a lot of what we learned from there is what kind of informed our investment thesis. So that's a little bit on my background and kind of why we started and a little bit on what we've done.
Awesome. Thanks for going through that with us. And I gotta touch on this student housing
Yeah.
real quick. Or actually, I'm sorry, let me go back to the car-free neighborhoods.
Mhm.
Because just to help me understand them and the listeners that are curious too, how does that work?
Yeah, I think there's a lot of different answers to that question. Number one, I think it works differently at different scales, right? When you're talking about a development for 600 apartments, it works very differently than a development with 40,000 apartments or 100,000 apartments, which, believe it or not, is coming. And so when we talk about the development that we built was about 786 apartments, and so that's a very different scale. Something like that, though, what we effectively did is you could think of it as buying almost the equivalent of one Manhattan block, where we were building a couple different major concepts that kind of float into it. First of all, we think of it as a 5-minute city, which is anything you could possibly want needs to be within a 5-minute walk of where you live. So wherever you live on this development, you need to be within a 5-minute walk of grocery, food, shared office space, communal space, park space, whatever it is. And so that was really critical, and that was a very important element of how we looked at designing it. The other piece of it that I think was very interesting is we talked a lot about human scale design. When you build 3 or 4 stories and below, humans actually psychologically think of that as human scale design. So these buildings are not so large that they no longer feel accessible to you. If you've ever walked down the streets of Manhattan, you're walking under 100-story buildings and 50-story buildings, and they feel larger than life. And so psychologically, your ownership for the Manhattan streets actually drops pretty dramatically. Versus when you live in a neighborhood where it's all 3-story buildings or below, similar to Hoboken, Jersey City, a lot of the kind of surrounding areas, Queens, Brooklyn, where it's all 3-story brownstones. Suddenly, you feel a lot more ownership over the community. It feels much safer. There's more eyes on the street. There's more walking on the street. It really actually helps to activate a community. So these are some of the concepts that we kind of played with. But then the big and obvious one was simply we are trying to create walkability. And so when we think about Eastern versus Western cultures, Eastern cultures are all about collectivism, right? They're all about community. Western cultures are a lot deeper about individualism. When we think about that in terms of the United States, I actually think a lot about cars. Our infrastructure in this country was built around cars. Whereas when you go to European countries and Asian countries, they're built around public transport, right? You have immaculate train systems in places like Japan. You have an incredible connectivity throughout Europe based off of rail as well. Whereas in the United States, we're all about cars, right? We're optimized for the vehicle. And the more you optimize for vehicle, the more it's kind of an endless feedback loop because the more people that are dependent on cars Every time you build something, the more parking you need. And then because there's more parking, there's less efficient, usage of space, at which point everything is further apart, and then people need cars to go to those places.
Right.
And it's an endless feedback loop. And so there's this study that says about 68% of humans want to live in walkable neighborhoods, but only about 8% do. And so what our company was doing was trying to build developments to bridge that gap, and create small walkable neighborhoods for humans. We did that to start as a litmus test for around 1,100 people was for that first development. The second development, we were looking at about 3,000. The third development, we were looking at about 8,000. And now there's actually other companies that have come up to take up the mantle as well. You should take a look at, and everyone listening should take a look at a company called California Forever. I believe they just rebranded to the East Solano plan. A lot of folks that were at my old company have moved over there now. They're actually building a city, a car-free city from scratch for 400,000 people in California, about an hour and a half from San Francisco. So imagine the scale required to build a city for 400,000 people from scratch. And that's a dramatically different way of working, because suddenly you now need internal public transport, right? A 400,000 person city is about a quarter of the population of Manhattan. So imagine building a quarter of Manhattan today. It's incredible. And so the scale and is dramatically different for how it would work for something like that. And that's something I'm excited to get my hands on to a little bit.
Yeah, no, that's very interesting. And, it makes me think because, like, growing up and just having to have vehicles and just the way, the landscape is, you're just so used to, all right, driving from point A to point B, right? It's just the normal. You don't really know any different. But as I think, like when we just took a trip to the beach, right? And I, found a location or was able to get a location that was in walkable, that had everything I needed in walkable distance. I mean, restaurants, grocery, the pier, right, to take the kids on. Of course, we were right off the beach. Everything I needed. I mean, we, didn't even drive our car for 3 days or so while we were there. And how convenient that was. And I would rather not drive. I mean, if I could just take a 5 to 10 minute walk down the road, why not? But yeah. Anyways, thanks again for walking. Because I honestly, I've been in real estate a while and I've never heard of the
Yeah.
car-free space.
And I'll add something to that quickly, but to your point, humans do want to live that way. A lot of it is climate dependent because the walkability doesn't work as well in a place where it goes minus 10 degrees in the winters.
Right.
But in a place like Arizona where it's walkable year round and the weather is warm enough, at least in some cases too warm, it works. But the one thing I would add there is we talked about the individualism versus collectivism. We in the United States love to step into our metal boxes that separate us from the rest of the world, drive to our precise destination, honk at everyone on the way, at least in New York, honk at everyone on the way, and then, park, get out, go to where we need to go and come back and not interact with anyone else, right? It's that same concept of the 3 stories versus 100-story building. Of when you're in a car, you have anonymity. You're not interacting with your environment. You're not interacting with your community. Everyone gets a little bit more rash when they're in a car. They get a little bit more individualistic. Versus if you're on a bike or if you're walking, suddenly you smile at your neighbor, right? You say hi to your neighbor. You can much easier stop on a bike because there's no cars behind you that are going to honk, right? You can just stop on your bike. You can talk to whoever you're passing. Every day when you're walking home, you're passing by your friend's place and you can just knock on the door and say hi. That's really the way we were, in my opinion, meant to live. And I think as we kind of show people that, more and more people will hopefully opt for that. And that's actually a large reason why a big part of our investment thesis or our long-term investment thesis is really buying in walkable neighborhoods. So existing suburbs that are walkable neighborhoods, downtown walkable retail. We talked about mixed use a little bit before we started chatting, but mixed use is a huge element to that, right? Apartments above, retail on the bottom. people being able to be walking distance from, entertainment and food and grocery and the people that they don't love.
Yeah. Well, and you build a community, right? Like you, because even so, Arizona's definitely different than New York, right?
Yeah.
I visited New York when I was younger, and yeah, it's what you see on TV. It's literally taxi cabs honking at each other and just
Yep.
people running over you on the sidewalks, right? But so I'm originally from North Carolina,
Mhm.
and we do like you. It is more friendlier, I should say, than some people out here in Arizona. And I think over the years, it's we've all changed a little bit in that way. But you ride down the road, you do ride your bike or something. People are sitting on the front porch, and
Yep.
it's how the houses are designed. I think Arizona is more of a backyard environment than it
Mhm.
is a front yard. Like that has a big
Yeah.
aspect of it too. Where I've seen literally, I got neighbors that I've been in this house living almost 6, 7 years. My wife's been here almost 12, and we've interacted with the neighbor maybe once or twice. He pulls
Yeah.
in, closes your garage before he even gets out the car, and I might see him watering his lawn once in a
Yeah.
while. But and North Carolina, hey, you're waving, it's just a different environment. And a lot of us don't like change too, right? I know I'm guilty of that. I get set in my own ways, and this is how it is. This is how it should be. And I think what y'all are doing opens us up and puts us in a position, if you're going to live in a community like that, to
Yeah.
interact and force that interaction a little bit more than in the typical day to day.
Yeah.
So
It's behavior change, and behavior change is hard. And to some degree, to your point, right, the real estate in North Carolina is different than the real estate in Arizona, and they're built differently. And believe it or not, that the way that they're built influences our behavior and the way that we interact with people. And
um,
but when you build something new like this, the question becomes, when you build it, do the people come, or do they come not knowing what it is, and then when they get there, it changes them, right?
yeah.
And it'll be interesting to watch and see how that evolves as more and more companies kind of pick this model up, and more and more of these developments are hopefully built over the next 100 years.
Yeah, yeah. Well, and I'm gonna go check that 786 unit apartment out there
Good.
too.
I'll send you the address later.
Yeah, please do. Yeah, it's 20 minutes down the road from me, so definitely curious about that. All right, cool. Well, I'm gonna go. I do want to transition into student housing. So
Yeah.
we've had, like we were talking before, I've had quite a few guests on here, and we've gone over a lot of different asset classes, and for the new listeners, we've talked about self-storage, of course, multifamily is where I really focus heavy on, in the value add 1980, 1990s build B plus properties or B class properties, I should say, where we're renovating them and fixing them up. But, we've even had somebody on here with that does marinas. So they buy marinas, either hold or sell those in 3 to 5 years. We've done, let's see, notes, debt funds, all these different asset classes, right? But I haven't really dove into student housing. And I will share for the audience, if you're curious about those other asset classes, please check out our previous episodes. You can go in there. We've got different operators that are talking about that, even oil and gas, too. That was another one. Let's talk about student housing. I
Mhm.
know y'all use Section 8 housing as well, the strategy there to cap the rents at a certain, make it more affordable, right, for the
Mhm.
tenants. And if we can talk about returns, depending on how these deals were structured,
Mhm.
obviously adhering to the SEC regulations there. But yeah, kind of walk us through maybe and even go over the difference between like the multifamily and the student
Yeah.
housing because they're very similar in a way, but how and maybe how they perform. But yeah, if you could just go over
Yeah.
the differences. Yeah.
100%. A lot of our work has been focused on student housing, because this idea of community living and walkability, I think, is embodied in the college town, the USA college town. I had some of the best years of my life when I was in school. I went to Georgia Tech in Atlanta. And so I was lucky enough to be living in Midtown Atlanta, where I had access to a significant amount of walkable retail, apartment buildings, houses. I mean, it was a fantastic, fantastic place to live. And I think a lot of my motivation for wanting to be into student housing was precisely that I enjoyed my life as a student so much, and I enjoyed the relationships that I built as a student so much that I would love to be a part of other people's story as they build those parts of themselves. And as we just said, real estate can influence people, right? It can influence the way that they interact and meet with people. And so if there's a way that we can help make college towns a little bit better or the college living experience a little bit better, I'd love to be the person who does that and make my investors a lot of money while we do it. In terms of student housing itself, it is multifamily, right? But it's a subsection of multifamily to a certain degree. There are exceptions to that. I think it's very dependent on the college town itself. Some college towns are a little bit denser, and so you'll have, larger unit count buildings, you'll have mixed use buildings. Some college towns are really not very dense, and they're all single family homes that you rent out by the bed to individual students. What I think are the couple main differences between student housing and multifamily, first of all, I like to compare it to how we think about shopping centers. When someone looks at a shopping center, there's a big conversation around, a shopping center versus grocery anchored shopping center, right? A grocery anchored shopping center, people love to buy those as stabilized investments because they know that there's demand there, right? They know that people are coming for the grocer, they're coming to do their grocery. And so now the nail salon and the hair salon and the soccer post and the dentist and all the other tenants now get visibility because I'm driving, or in my case, I'm biking, but everyone else is driving to the shopping center to get their groceries, but now they see all these other tenants. And so tenants love to be in grocery anchored centers, but investors also love grocery anchored centers. I have a big fear of grocery anchored centers because the grocery model is still up in the air, candidly, right? I mean, with Amazon Fresh and Whole Foods and all of the virtual ability to buy groceries today, Instacart, all of these things. The jury is still out on, are these, how many of these grocers are growing? How many of them are contracting? Aldi, I think, is a really good example of a grocer that's been growing really significantly in the last couple of years.
Well,
But
and
there's
real
a
quick, when you refer to grocery anchor centers, is that what you're referring to, like the Aldi, Whole Foods, Sprouts?
Yeah, Aldi, Whole Foods, Stop and Shop, ShopRite. I mean, it's regionally based
Yeah.
because Arizona is going to have Sprouts. It's going to have I forgot what else is down there in Arizona, but I
The
know the
fries. Yeah.
Sprouts. Yeah, Georgia's going to have Kroger's and
Yeah.
Publix, and so grocery anchored retail is exactly that, right? And so in multifamily, I think of student housing as effectively university anchored multifamily, right? That's what it is. It's stable in the sense that there is always going to be a demand because there are always going to be students that need to come to this university. And so this real estate is always going to have tenants. Versus if I buy the 20 unit in a town in New Jersey where there is no real driver other than people have, lived here and maybe the schools are good, right? All those things can change, right? They can build a 300 unit down the street that's cheaper, and there's nothing holding people there, right? There's nothing. The downtown 2 towns away can develop way better, and people want to move there. Versus universities aren't moving, right? Rutgers University, New Brunswick is where Rutgers University, New Brunswick is. It's not moving. And the 200 houses that are closest to it are the 200 houses that are closest to it. Those are not changing. You can build a 300 unit that's a mile away or 2 miles away, but it'll never be closer than the 4 bed, two family that's right across the Rutgers Student Center that's been there for 100 years. So there's a couple challenges that come with student housing. While the university anchor itself is fantastic, there are a couple challenges. Number one, they sell at very, very low return rates. So your going in cap rates are very, very low because people recognize that there's a safety to being next to the university. But what it also is, it's a lot of non-professional real estate investors is the term I'm going to use. A lot of people who are just buying it to buy it and don't actually, I think I heard you or I heard one of your guests say this in a previous podcast. But they mentioned that everyone says they're conservative underwriters, but nobody actually is, right? Or everyone says they are. You'll never find somebody who says that they're liberal with underwriting. And I think non-professional buyers, especially ones in the student housing space, they are the definition of non-conservative underwriters. They don't look at repairs and maintenance. They don't look at reserves. They don't look at potential property tax increases. They just see what exists. They buy it at a 10 GRM, so gross rent multiplier, and they buy it, and that's it.
Hmm.
And so it's hard to compete in that space because you have a lot of people who are just looking to buy because they know it's secure without actually knowing what the return is. So that's one issue. The other issue is the operational side. The operational side is very, very difficult because every year you're retenanting, right? Every year there's, first of all, you have students who want to be on a 9-month lease because they get the summer off, but you're signing them for a 12-month lease. What we do though is legally we don't actually write it as a 12-month lease. What we do is we write it in as a 50 or 48-week lease that's split into 12 payments, 12 equal payments. So that's a key difference there because what it is we're still getting 12 payments as if it were an annual lease, but we're getting 2 to 4 weeks in the middle of each lease where the area is vacant, so that we can turn the units. Because what happens is if we own 100 units right next to Rutgers, all 100 of them are turning in the same 4 weeks. So that is a nightmarish scenario. Whereas when you buy a 200 unit, just, if for professional housing or whatever it is, you're very rarely retenanting more than, 4 or 5 apartments at a time, max, right? Maybe, 10 is really pushing it at that point. And so that's a really important difference is the operational heaviness of those is very different. There's a lot of unique business models in the student housing space. I think the way that we look at it right now, long-term cash flow and land control are the two things that we really think about. And so that's simply exactly what I said before of the 100 houses that are the closest to Rutgers University are always going to be the 100 houses that are closest to the university. And so can we establish a 100-year fund where we buy up as many of those houses as we can, establish land control, even if the going in return isn't really significant, right? If it's 5%, 6%, whatever it is. But we can establish land control to where we get 4 houses in a row, and now we can build a 60 unit, and suddenly our cash flow shoots up, right? That's really how we're thinking about some of these things. The other element to it being, if you're familiar with the cohabs model, Jarod, are you familiar with cohabs in New York City by any chance?
No, I'm not familiar.
So interesting company. I don't think they have any presence in Arizona. But what they do is they are buying buildings, gut renovating, buildings nobody wants, gut renovating into effectively large, almost rooming houses. So big shared house, big shared facility. There's this great video of one of their tenants where he's basically giving a walkthrough of his cohabs unit in Brooklyn. What it is he has 27 roommates. So he has 27 people that are all living in the same apartment. But you get the option when you're signing up. Do you want a private bedroom, a private bath, a shared bath, a bedroom, et cetera, et cetera? Everyone has a shared kitchen, very large, dining table, a lot of, community study spaces. You have, cleaning folks that come in. But really what it is if you're coming from internationally and you want to live in New York City, let's say, number one, you don't know anybody. There's that whole trope of when you move to a new city, it's very hard to meet people. And so what Cohabs does is they give you 27 roommates that you can now be friends with, right? But then on top of that, they provide shared services like cleaning and all those kinds of things. And you get to select, do you want the private bedroom, the private bathroom, whatever it is you want. But it's also cheaper than getting a 1 bedroom, 1 bath, right? If I got a 1 bedroom, 1 bath in that same area that Cohabs unit is in, it's probably going to be about 1.5 or 1.7x the monthly cost that it would be for living in Cohabs, because Cohabs has 27 tenants in the same, very large scale apartment. We're talking about probably a 18-bedroom building that they're putting 27 people into. And so fantastic model. And the question we've been asking is, could we do that with student housing? Because already when you talk about student housing with professional investors, they talk about a buy bed, But when you lease, you don't actually lease things by bed, right? You know that students are paying per bed, but the lease that you sign is for the full unit.
Yeah.
And so we've been thinking more and more about, can we apply a cohabs model to student housing to where we can buy some of these old buildings, and instead of developing land control, can we gut renovate? Can we build nice shared services? We have a cleaning crew that cycles through maybe the 12 buildings that we have in that area or the 15 buildings that we have in that student housing area. Instead of having, 3 units with 3 beds each, we have, one big unit that has 9 bedrooms, or maybe 10, 11 bedrooms shared amongst 15, 16 people. And it's all individual students that have leased the bed individually. They have a much nicer place to live, but they also now have community. Because I think what you find is you have a lot of students, international students especially, that are coming in, have no relations in that campus, are looking for a clean, safe place to live, but also, they can't find the 4 or 5 roommates that they want to live with. And so but they don't want to live alone. That's way too expensive. And so living with a group, building relationships, having shared services. It's a space that we're really interested by that we're about to launch a litmus test on.
Okay.
And hopefully it works out.
Have you heard of pad split?
Pad split? No, I haven't.
So check that out. It's a similar model on a much lower scale, but they're buying houses, right? And I
Yeah,
mean anywhere from 3, 4, 5,000 square foot house, or I mean it could even be a 2,000, but they wall them off, wall off all the rooms to on a 2 bedroom or 3 bedroom 2 bath house to make it 6 bedrooms, 3 baths or 4 baths, but it's the same concept, right? Just
yeah,
livable space. And a lot of people, like me, and I don't know about you, but like that doesn't seem attractive to me, right? To live with a bunch of random people. But going back to that community aspect of it, like, and especially like in places like New York and even here in Phoenix, as well, Gurjote. I mean, it's pretty
yeah.
pricey to even rent, a 2 bedroom, 1 bath apartment, right? So, that makes it more affordable,
Mhm.
more easier to maintain, right? You don't have to, got your little room, you got your shared livable space. They have a cleaning crew that comes in,
Yep.
cleans it. You still have a property manager that manages the property, and then you have your investor or owner who's,
Yeah.
removed from the day-to-day operations.
And hopefully making more returns because they're leasing out by the bed, not by the unit.
Well, and to that, again, it makes more sense to buy a single family because it's so hard. Honestly, it just probably familiar with the bigger pockets. They talked about
Yeah.
the 1% rule, right? I mean,
Yeah.
if you buy a house right now that's just a 3 bedroom, 2 bath, or even a 2 bedroom, 1 bath, it's you're not going to be cash flowing on that deal. You're
No,
buying it for the equity and the land,
correct.
right? That's essentially, unless you got
100%.
smoking deal on, I mean, not saying they're not out there, but it's very, very hard to make something pencil like that. So that's
One
how
of one of my mentors uses this word. He uses this word dislocation. And he said back in the 60s, 70s, 80s, that's how they made money was there was dislocation in the market, which is basically this idea that because there wasn't information out at the same availability that it is today, he used to run up and down Harlem, buy 3-story brownstones for 50, $60,000 in the 60s and 70s, and within 3 weeks flip them for 80,000, 100,000, 200,000. And he was like, every week I was making 40, $50,000 on these flips. And it was just that easy, right? It was literally like taking candy from a baby because
right.
you just and the word he used for it though is dislocation. And to your point, that dislocation doesn't exist anymore the same way it used to. The 1% rule, forget that. It used to be like a 2-3% rule in
Right.
the 60s and 70s.
Yeah.
Now the 1% rule, I mean, it's virtually impossible to find a deal that even meets the 1% rule.
Yeah. When there's
And
a phrase I like is like, we got to adapt to the new normal, right?
yeah, 100%.
Yeah. Because and a great point. I like that dislocation, and it's really just being creative, right? And finding more creative ways, like to your point about the 18 bedroom,
Yeah.
apartment, right? Just knocking down all the walls and rebuilding, what's and somebody can pick, hey, you got bunk beds in the middle of the floor, or you can have your own private room, and then you pay based on how private you want to be. So I think that's a great model too.
And I think there's a certain age where it works.
Right.
Uh,
Well, especially the younger generation, they don't want to own neither, right?
yeah, I mean, for you and me, to your point, we don't want to share bedrooms. We don't want to live in a shared bedroom house. But young folks in college, that's exactly what they want,
Hmm.
right? They might want the private bedroom, but they do want to interact with people in their common room, no question.
Right.
That's the thing that they actively want, and then hopefully that extends to some early and young professionals, 26 and under, 28 and under, whatever it is, and that's the cohabs model. But for us, we're trying to take it even lower. I think the trick is making sure it doesn't turn into a frat house.
Yeah.
And that is the part that we've been tackling, is how do we do that? And I don't
Yeah.
know, but
Which I imagine that's even an issue with just the student housing alone,
it
right?
is.
You know.
I remember I was touring a building. It was a great deal. They had advertised it as like 18 beds in 3 different units. We went, which is a lot, right? We
Yeah.
went through it. First of all, the owner had added beds in the attic and the basement, like, non-legal
Right.
areas to add beds. And so 18 beds was really like a legal nine. I went to the basement, and the whole thing was just a tiki lounge, and it had the frat letters on it, and it somehow had like a bus bench and the door from a bus, and it was insane. There were tiki torches lit in a wooden basement. And I'm just screaming out of my mind here as, wow, this is the biggest hazard you could possibly have, is a frat house, as your tenant. But for a lot of people, that's consistent income, right? And that's fine.
Yeah, tiki torches in the bottom of the basement. That's a wooden basement. Yeah.
Yeah, scary
So
ability.
I bet. Oh my goodness, the stuff, yeah, you come across. Well, let me ask you this before we go into our last final segment of the show here. So you seem very knowledgeable about the market, and I love your insight too on just, the creativity and the future, right, of real estate. We know the Fed just dropped. We're recording this, what is it, October 14th here in 2024. The Fed just dropped 50 basis points, and looking to possibly drop another 25 at their next meeting, and possibly another 50 before the year ends.
Mhm.
But where do you see, what's the macro outlook of where we're at, and where real
Uh,
estate is going here, maybe the next 18 to 24 months? Your
yeah,
opinion. Obviously, you don't have the crystal
sure,
ball.
of course.
Yeah.
Yeah. First and foremost, what I would say is real estate is obviously a very broad term. And so what I'm going to narrow that down is commercial real estate, because
Commercial. Thank
I
you.
don't know
Yeah.
residential, but I
Yeah.
know commercial. And my general answer to that is, since the 50 basis points, I have felt nothing change. I've felt maybe a little bit more activity in terms of sentiment, but I haven't actually watched deals change. I haven't watched more buyers enter the market. I haven't seen sellers change expectations yet. It's funny. I haven't seen much. And I remember the day that the 50 basis points dropped, I even called half of my board members and I said, "Hey, what's going to happen? What are we thinking here?" Right? And consistently the response was, it's a step. It's not a change. It's a step. It's a step towards a change, right? When it becomes a trend is where it becomes, actual change. And so I'll be interested to see what the Fed's guidance is, and if they continue to ease the monetary policy over the rest of the year. But I think any fund manager or any syndicator that is underwriting their deals assuming interest rates are going to drop, which I'm going to be clear is 80 to 85% of syndicators and fund managers, they are doing a disservice to their investors and to themselves, because I would love for them to drop, and all of our deals will do extremely well if they continue to drop. However, we are not going to buy a single deal unless it pencils, assuming interest rates even expand back 50 basis points up. Simply because anyone who tells you that they know where interest rates are going has not actually been in this business for a full real estate cycle. They don't know. Nobody knows. I don't know. Nobody knows, right? We can hope, we can pray, we can do whatever we're going to do. But what I'm going to do is simply I'm going to do deals that I know work, whether interest rates go down or whether they even expand another 50 to 100 basis points. I always, whenever I underwrite a deal, I always calculate, hey, how high does the interest rate need to go in order for our returns to plateau? And generally, we're talking rates need to be at 9, 10% before our deals plateau in order for me to go for something. And that's just my simple requirement. Now, that said, real estate is inherently a cyclical business. And so even if rates go up, if rates go down, they will inevitably come back up or come back down. And so as long as you have the long game in mind when you invest in commercial real estate, you will be fine because you can own an asset through a rate increase, you can own an asset through a rate decrease, and you can time it where you sell it in a rate decrease and you can do well. So that's my general outlook. It's a lot of hopes, but I try and be extremely conservative and borderline even pessimistic when I look at the market because I want to only do deals that work in the worst cases of scenarios and do extremely well when things are better.
Yeah. Well, no, I love that answer because it really just sums it all up to it's real estate is a long game. You're not looking really 12 months down the road. I mean, most of the deals we're in are 5, sometimes even 7-year holds, right? That we possibly might even just refinance at that time and,
I
depending
hope.
on where the rates are and just keep distributing, cash flow throughout that period. So you just, again, you never know, but you just stick to the underwriting. This is, I think it's one of the easiest said but hardest things to do is you stick to the numbers, right? Get the emotion out of it. And when I say that, because it's hard when you really see a deal and you're like, this is a great market, it's a great opportunity. But to your point, if you just be overly pessimistic and assume the worst case scenario, right? And you're underwriting, do your stress tests, everything that's involved there, those are your numbers, right? And then now it also depends on the debt. All right, now we're gonna go into what I like to call the fire round. The fire round, Gurjote, is where I ask 4 questions. The first one being if you could recommend a book on real estate for real estate investors just starting out in this space or just looking to explore the, option of passive investing or whether they want to, be passive or active, figuring out that. And another book on cultivating a positive mindset.
There are 3 books I'm going to recommend here, or I guess technically 4. Multifamily Millionaire Volume 1 and 2 is a classic. It's a great place to start for just learning real estate investing. But in terms of the more positive mindset and even just the investing mindset, there are 2 books I absolutely love. One, Charlie's Almanac, which is a collection of stories and lectures by Charlie Munger, also known as Warren Buffett's right-hand man. I think if you're thinking long game, Charlie Munger's the man. And then the second one is The Psychology of Money. Same thing, fantastic read and something that really, really helps you think about the long game and cultivating a mindset in that space.
Yeah, no, great books. I've read The Psychology of Money. I'm going to definitely check out the Charlie Munger book. Yeah, actually, I was reading through your, it was either on your website or maybe even your LinkedIn, but I saw some Charlie Munger quotes there
Yeah.
from you. So, yeah,
Yeah.
great
I love
insight.
Charlie.
Yeah. He's definitely got some great insight. Well, cool. If you could share a specific goal or dream that holds special significance to you.
Yeah. We talked about my dad earlier.
Yeah.
We used to always joke about how one day I'll give him a corner office in whatever company I start. So I think the special goal here is I'd like to retire my dad in the next couple of years and, hopefully give him a corner office.
Awesome. I love that. Now, and just to clarify, I think you said this earlier, but he still owns that business,
Does. He
paying
still works.
$26,000 a
Yes,
month
sir.
in Manhattan for a 15 or 1600 square foot.
Yes, sir. And he used to work 7 days a week and I work 6.
Nice.
So
Okay,
still
good.
more
Yeah, yeah,
than
yeah.
most people. But so we took it a little slower after COVID. But still working crazy hard. So,
Yeah,
we're looking forward to getting them retired up in the next couple of years.
that's cool. Yeah, love that. So, with all this work we do, and let me ask you this question before. Do you have a or let me do you have a family, kids, or
Myself, not yet.
okay.
I'm a very family-oriented person, so I think a lot about legacy. So, I care a lot about the forefathers and everything there. One day soon.
Okay, cool. Yeah, was awesome. And well, and I didn't even read this kind of with the intro, but I know, you're very passionate about growing the wealth of immigrant families, and just helping them achieve the American dream, right? So, with that said, how do you structure your day to maintain a healthy work-life balance? Because it's really easy just to focus all our energy and effort. And, like for me, and it sounds, I can just tell by talking to you, I'm very passionate about what I do, right? As I can tell you are as well. And it's easy when you're passionate about it, you're working all these hours and sometimes we can lose sight of our, taking care of our health or, doing other stuff outside of work. So how do you maintain that balance? And do you have a morning routine that you can share with us?
So I think as all humans, we're all constantly evolving and changing and learning. And the morning routine part of my life is still something that's evolving. So hopefully more updates on that the next time we chat. But in terms of the work-life balance and the structure, I have a couple answers to that. I think first and foremost, I reserve work-life balance for my passive investors. They can have that. My job is to not have that on their behalf and make them all the money that I possibly can so that they can live those lives. And hopefully one day we can, I can also live that life. But candidly, my life is my work and my work is my life. And those things really, they all kind of stick together. It's very hard to separate the two things. But I think the trick to that is make sure that your work involves play, right? Despite the fact that I work probably constantly, I still play golf once a week. I play pickleball 2 to 3 times a week, and I play soccer once a week. All of those things are helpful in terms of taking care of my body as well as building relationships with people that, half the people that I do some of those things are some of my investors actually. And so it's a great way to continue to build those relationships. That said, you're always on, right? And that's kind of part of your life. And so I think it's hard to really separate those two things for me, but I'd love to, what I'll say is I hope my passive investors get to achieve work-life balance and I'll be over here hopefully trying to build their wealth on their behalf.
I love pickleball. Like I've played it probably a handful of times and just an awesome sport, right? But and I was talking with a good friend of mine the other day, is actually a partner. We partner on deals together and we were just talking about, the people that we get to interact with in this business. I mean, just so many of them just have growth mindset, positive people, and going all the, to my investors as well, right? Like and to your point, like some of the ones you play soccer with, like I just this past Sunday, today's recording this on Monday, actually, so yesterday, we I went on a 20-mile bike ride with one of my
Mm,
investors, right?
mm.
It's just, you can build the relationships and help them accumulate wealth, but at the same time, it's cool to interact with the people that are
Yeah.
investing with you
While
and
taking care of your health and your body and your mindset, right?
right.
You can do it all as long as you're willing to bleed things in together.
Absolutely. Yeah. So yeah, love that. And then final question, kind of getting a little deep here. If you could
Hmm.
be remembered for one thing, what would that be?
I talked to a lot of mentees about this, and this is a conversation on motivations. Some people are motivated by impacting the world, some are motivated by impacting organizations, and some are impacted by motivating individuals. I sit somewhere in the middle of organization and individual. And so if I had to be remembered for something, it would very simply be all the individuals I interact with. I hope that they leave our interactions more energized than when they came in. That's it. That's my only goal. More energized, more happy. If that's something that I do and I accomplish, and I do that while building a fantastic organization, I lived a good life. And so that's what I hope to be remembered for. I'll say this in context of real estate. There's 5 reasons why someone sells. If you're in the commercial brokerage community, you'll hear this often, but they'll actually talk about the four: death, disease, dissolution of partnership, and divorce. Those are the 4 reasons that most people talk about. The fifth one, which I coined, is dumb kids. And that is simply, someone worked really, really hard to build a very large real estate portfolio. They built it, they grew it, and 2 generations later, or 1 generation later, they decided they don't want to deal with it. They just want to liquidate, make the money, have big bank accounts, and go away. That's that fifth reason. And I say this very often. I think every dollar of real estate that I buy is going to get liquidated in the next 100 to 150 years, and all that work will go away. And so, honestly, it's not something to be remembered by. But if I left individuals feeling better every time I interacted with them and a little bit more energized, that's a great way to feel.
Yeah. Well, I can just tell by talking to you, this past hour or so that you have that energy, right? So yeah, just keep doing what you're doing, because I mean, you have a way of communicating that does it. You're easy to talk to, right? And I think you really
You as well, Jarod.
well, thank you. I appreciate that, and I think it's I have been referencing this book a lot, and if somebody's listened to the past 3 episodes, they're going to hear me say this again. But just that go-giver mentality, right? If I can go into whatever situation I'm in, whether it's helping an investor look at a property, or whether it's just a conversation like you and I are having, or whatever the case, or conversation with my kids, or somebody at work, how can I bring value to that conversation, and just add as much value as possible, right? Yeah. So both parties come away, feeling like they were able to get something valuable. I'm gonna use that word again, out of that interaction, right? And so it's just, and I believe, like, the more, what's that Jim Rohn quote? I'm going to totally botch this, but you just have the idea just to help a million people, right?
Yeah.
And by doing that, I'm going to be more than taken care of, right? Whether that looks like the way I want it to or not. Like, it's nice having money in the bank account, but really what, and I love this word fulfillment, right? Where I get fulfilled is when, I'm able to sit down and help somebody else out, and just, again, leave them better than we
Fortunately, that's what this business is all about. We get to do that not only for our investors, but if you do it right and you do it creatively, you can do that for your tenants also.
Yeah.
And so hopefully hopefully we get to do that every day.
Absolutely. Absolutely. Well, Jarod, I enjoyed this. I really did. And you made me feel better than we started the conversation.
That's all I can hope for.
You achieved your goal for today. You're on it. So if you could, though, tell listeners where they can connect with you, learn more about what you're up to in the student housing space.
For sure. Feel free to connect with me on LinkedIn, Gurjote Sethi. Or you can hop onto our website, www.hukamcapitalgroup.com. Would love to chat with anybody who's looking to passively invest in the student housing space, as well as all of the other great things that we invest in.
Awesome. Thank you. Well, again, I enjoyed it, and good luck with your upcoming projects.
Thanks, Jarod.
Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.